Hey, what's going on, traders? Thank you for joining the Minimal Trading community. My name is Lawrence. I'm the founder of Minimal Trading, and this is the first segment of my day trading course meant for beginner and intermediate traders. I hope you guys enjoy it, so let's jump right in. So over the next few weeks, I'm going to be dropping this course segment by segment to give you guys time to digest it and also give me time to finish it. All right, so we have the table of contents, introduction to day trading. So pretty much this is just going to be telling you what to expect out of day trading, to go in with the correct expectations and not based on what the internet or social media portrays it to be, but what it actually means to be a trader. Next, we have technical knowledge. This is going to be about technical analysis, like pretty much the one-on-ones and fundamentals of technical analysis. So market terminologies, candlesticks, pivot points, patterns, and chart ratings. Just a basic rundown. Then we have developing a trading plan, which every trader needs to have in order to make consistent profits over time. We have to have an objective and repeatable trading plan in order to be consistent over a long period of time. So a trading plan pretty much consists of entries, profit taking, stop loss strategies, position size and risk management, back testing, and refining your plan, and making it all one big system so you can continue to perform at your peak. As we talk about what day trading is and the correct expectations, as we talk about technical analysis and developing a trading plan, I'm going to be trading live so you guys can see this in real time. And then we have mindset and psychology. So think of your trading plan pretty much as the strength, and then think of mindset and psychology as the endurance, right? So in order to maintain discipline, consistency, and emotional regulation over your trading career, you have to strengthen your mindset and psychology. So we'll be talking about mental shift resets, managing greed and fear, how to become a better loser, building confidence with uncertainty, and overcoming impulses in emotional trading, along with trading on tilt. Then we have execution and performance. Trading, just like any sport, business, or game, is a performance-based activity. So setting daily goals, recording your trades, and journaling to improve your performance over time will go a long way. And I'll show you just how to do this. And then we have advanced topics such as scaling up your trading account, leveraging prop firms for more profits, and managing P&L consolidations. These advanced topics will be touched after you pretty much master number 1 through 6 on the table of content. So number 8, we have live trade walkthroughs. This pretty much piggybacks off the live trading strategies. The difference between the two is live trading strategies is more so towards the technical aspect, where live trade walkthroughs is more psychological. So when I talk about live trade walkthroughs, I'm talking about step-by-step analysis of key trades. Key trades are the trades that are examples of how you want to trade at your best. And also key trades can be examples of the worst trades that you've made that you want to improve on, refine, and get better at. So while I'm trading, I'll try my best to give you guys like a dialogue of what I'm thinking, like when I express my emotions, if it's fear, if it's greed, if I want to do something impulsive or not, and how do I combat those. Then number 9, we have risk management mastery, where I will teach you how to handle drawdowns, preserve capital and staying in the game, building a buffer for consistent payouts. Risk management is normally overlooked in the trading community, where 95% of people who actually fail only worry about the profits instead of actually worrying about the losses and the risk. And throughout this course, you'll start to see that I'll rarely talk about money. Everything is going to be centered around risk, loss, and process. It's not going to be profit and outcome, okay? So that's going to be the main thing here. And then lastly, building a trading career. If you aspire to be a full-time trader, then I'll show you the steps that I took and steps that I didn't take that I wish that I did before becoming a full-time trader. So we'll talk about how to transition to full-time trading, setting financial and lifestyle goals, incorporating passive income streams, and growing wealth beyond trading so you can eventually retire from trading if you choose to do so. For the first segment, we're going to uncover the intro to day trading. Day trading is a resale business. We're buying a product and selling it in hopes of a higher price for a profit, right? So it's basically a resale business. There's nothing different between flipping shoes and flipping stocks. Now we're going to move on to the goal of a day trader. A day trader has 3 goals. Very simple: direction, timing, and target. We have direction. We want to identify the price direction, right? So is it going up or is it going down? Then we have timing. When to enter a trade. When will the price go up or go down? And then we have the target. When to take profit or loss. How far will price go, right? So we need to figure out what direction price is going to go in, when will it go in that direction, and how far will it go before we need to exit. Our job is to build a solid plan that makes it likely that we get each one of these questions right so we can profit. So let's go ahead and talk about how we can achieve each one of these goals as traders. So to succeed as a trader, you need an edge, a tested strategy that will consistently help achieve the 3 goals of a trader, which will give you a higher chance of winning than losing. And I'll be sharing mine with you later on. So 1, direction. Identify price direction. Is it going up or going down? To determine if the price will go up or go down, we're going to use either trends, pivot points, market structures, or patterns. I'm going to give you the basic definition of each one of these. I'm not going to dive too deep into that. That's going to be for the technical knowledge segment of the course. So we have trends, the general direction of price, whether it's moving up or down. Then we have pivot points, which are my personal favorite. So pivot points are a candlestick pattern that shows a strong sign of reversal or consolidation in real time. A lot of times when traders trade, they normally miss their entry looking at lagging indicators, right? So when we look at MACD, RSI, all of those are lagging indicators, which means the move has already occurred by the time we get the information to act. So it's lagging, right? We're too late. Where pivot points actually give you the trend change in real time, giving us an edge to guess price direction and also timing more accurately. Then we have market structure, a series of trends and pivot points that shows the overall setup of the market, also known as the big picture. So whenever we get a trend or whenever we get a pivot point, we just don't look at one trend and one pivot point. We pretty much have to get like a collective of trends and pivot points, you know? Can't just rely on one thing and think that this is going to happen. And the term that traders normally use, and you might have heard it, is confluences. We want multiple signals saying the same thing to increase our chances of being correct. And lastly, we have pattern, a series of candlesticks that create a repeated shape or pattern that hints at what the market may do next. Me personally, I'm a pattern-based trader, right? So I underline repeated because in order to be profitable in these markets, you need a repeatable and an objective strategy that's going to yield you a profit over the long period of time. So moving on to number 2, which is timing. When to enter a trade. When will the price go up and when will the price go down? Knowing when to enter a trade is more important than guessing the direction. There's been a lot of times early in my trading career where I would guess the direction right, but because I didn't time it correctly, I end up losing a lot of money. Not to say which goals are more important than the other because we need all of them, but I would think that timing takes precedence over direction for sure. So when it comes to timing, I want to help you think of it as a game because that's all trading is. It's just a game. And once you get into that mindset of we're just playing a game and the money does not exist, it will relieve you of a lot of mental and emotional burden. So when it comes to timing, we're playing a game of Hangman, Pictionary, or Wheel of Fortune, where the concept of these games is to start broad or with no clues whatsoever. Then we begin to gather clues, slowly refine our guesses as the answers become more clear, but we have to answer before it's fully revealed or there's no point in playing. So we start broad or clean slate, we gather clues over time, probably within a certain amount of time so we have limited time to guess this. And as the clues start to reveal itself, we slowly refine our guesses as the answer becomes more clear. And the best way for us to do this is to know our edge so well that we're able to guess the pattern, and the moment we guess is the moment we enter the trade. For example, if I asked you to guess this word down here, and every time you had to guess, you had to bet money on it, I'm pretty sure you would be really good at managing risk, number one. Like, you're not going to bet $1,000 on one go because this could be shops, it could be stops, it could be soaps, right? So you would manage your risk very well. But this is the whole point of the game of trading, right? Like, we get these clues and we get enough clues to a point where we are comfortable with placing the trade. So if I would go ahead and reveal one letter, boom, now will be perfect to place a trade. But understand that you may still be incorrect. First thing to come to my mind is slops, right? Shit, crazy. That's crazy. That's wild. But I'm gonna just use slops because that's the only thing that comes in my mind. That's crazy work. All right, so let's say this word is slops, right? And damn, my bad. I'm wild. All right, so let's say this word is slops, and I bet $1,000 on it because I'm so confident that this word is slops, and then come to find out, it slaps. You know, so that just goes to show how important risk management is. How you have to think in probabilities where there's always a chance that you may be wrong no matter how close you are to the answer, okay? But there's also a good probability that it could have been slops. That's pretty much the game of trading. You just never know, so therefore you have to manage your risk. Think about what are the odds of you winning and how much are you willing to lose in order to find out if you're correct or not. Moving on to the last goal. Target. When to take a profit and when to take a loss. How far will price go? It's all risky. It's all probabilities. So let's plan for it. One of the most important parts of trading is knowing when to take a profit and when to take a loss. This is very important because a lot of times we enter trades and we don't necessarily have a profit target or a stop loss, and that's detrimental because how do you know when to call a win when you haven't defined it? And how do you know when to take a loss early or when to stop out before blowing your entire account or losing a crazy amount of money that you was not prepared to lose? So we have to identify this criteria. Remember, it's all risky, it's all probabilities. Either one of these can play out, so we have to be prepared for both, but focused on stop loss. So be prepared for both, but we mainly focus on stop loss because the profits will take care of themselves. I heard this analogy by Oliver Balez. You guys can look him up on YouTube, but he pretty much said that our duties as traders is to focus solely on risk and our stop loss, right? Managing loss, because the market doesn't know when to stop. Meaning, I know there's been days where you've made a lot of money, or you've seen people made a lot of money because the market just ripped and ripped. And then there's days that you either lost a lot of money or you've seen people lose a lot of money because the market just ripped and ripped. So the mutual thing here is that the market just goes on a tangent and it doesn't stop. The only difference is what side of it you're on. And there's no real way to know what side of it you're going to be on until it's too late. For the situations where you are on the correct side when the market doesn't know how to stop. So for those situations when you're with the market and you're riding with the market in the same direction, the market is going to take care of the profits. There's nothing for you to do. You're good to go. Now, for those situations where you're not riding with the market and it just went the opposite direction than you assumed that it would go, that's why you need to manage loss, because the market is just going to keep on going in the direction it's going to go. And it's not going to be profitable for you and you're going to lose a lot of money. So that's why stop loss and risk is our job, while making profits is the market's job. I hope that made sense. So there are different methods for each. So the take profit methods are completed patterns, pivot points as well, because pivot points can act as support, resistance, supply, demand. The average true range. Average true range is the average range or dollar amount that a stock goes in on a daily basis. Like for example, SPY probably averages, depending on the time frame, it normally averages about $1.50 to $2. So a lot of times my profit target is either a completed pattern or it's $1 from the entry point. A lot of people use trailing loss, but I don't really like to use it. And the way that it works is that when the market is pushing up and just gaining a lot of momentum and it's just pushing, people take their stop loss and they move it up as the market is going. So once it retraces, it'll stop them out and they just took their profits for the day. Then you have risk to reward ratios. A lot of times we don't necessarily know how far the market will go. So if I place a trade and say we're at all-time highs or all-time lows, right? There is no historical data to show us exactly where the market would stop at. So if I'm risking 50 cents, I might just say, all right, I'm gonna do a 2 to 1. So my profit target will be $1 while my risk will be 50 cents. Because normally if you're in the right direction, price should go twice as further in your direction than the contrary direction where your stop loss is placed. So then we have stop loss methods. Break up a pattern or market structure. Basically when we see a pattern form and price breaks that pattern before it's completed, it is an invalid trade. That's just like if I tried to draw the shape of a triangle and at the halfway point, I turn it into a star. At the very point when we notice that this is no longer a triangle, that's when we need to get out. Then we have pivot points. Like I said, pivot points can act as support or resistance, supply and demand. So whenever they're breached, that can act as a stop loss as well. And then the average true range. So if my stop loss is the average true range, let's say $1, and price goes past that dollar and make it to $1.01, I will get out immediately. So that pretty much signifies that price is picking up volatility, therefore telling us what direction we're in. Okay, so quick recap. As traders, our goal is to build an edge that consistently helps us meet 3 key objectives. That's direction, timing, and a target. So one is direction. Identify the price direction. Is it going up or is it going down? And to determine price direction, we need an edge, a repeatable strategy that increases our chances of winning more. So it pretty much increases our win rate. Or if we have a low win rate, right, say like less than 50%, we have to make sure that the losses are small and the winners are big. And then number 2, we got timing. So when to enter a trade. When will the price go up or go down? We're playing Pictionary. We have to know our edge so well that we're able to guess it before it's completed. And the moment we guess is the moment we enter the trade. Put it on here, but the quality of the guess determines how much we're willing to lose to find out if we're right. Lastly, number 3, target. When to take profit or loss. How far will price go? Sometimes our edge doesn't play out, so we have to be prepared for when it does take profit and when it doesn't, stop loss. Our job as traders is to solely focus on the stop loss because the market doesn't know when to stop. So when we're riding with the market, when it's very volatile and it doesn't know when to stop, it profits us, we gain a profit, it benefits us. And if we so happen, for whatever reason, end up on the wrong side of the market, regardless if we took our strategy or not, we need to manage our risk and respect our stop loss because the market doesn't know when to stop and it will take all of our money. And so before we end our segment, I have quite a few actionable steps. Feel free to take screenshots and write these down and actually implement these into your trading because this segment alone will help you a lot with your trading, okay? So the first actionable step is choose your market and instrument. Pick the market you want to trade, if it's stocks, if it's options, if it's futures, right? Me personally, I do options and futures. Then narrow down to a specific instrument like SPY, ES, QQQ, Qs, or NQ, and get very familiar with that stock. And this is very important because a lot of traders, they go with what everybody says and go to all these different stocks that they know nothing about, right? Different stocks have different average true range. They move differently. Some of them are very volatile, where some of them aren't as volatile but have more follow through. And you need to choose one and learn this instrument. Me personally, I love to trade SPY options and ES for futures. And this is like picking your spouse. Choose what person you want to build a fruitful relationship and not a volatile one. You don't want to be a little hoe, okay? Like, do not jump around to different stocks. Choose one and learn to be faithful. Next, we have to find your strategy. So you got to determine your edge, right? Are you a trend follower? Are you a scalper? Do you trade reversals? And then use technical indicators or price action to support your decisions. Me personally, I only trade price action because there's only two leading indicators. A leading indicator is an indicator that is more likely to tell you what's to come, where a lagging indicator only gives you information for moves and price that has already occurred. So basically you miss whatever happened. And the more definitive and objective your strategy is, the better. Your strategy is your GPS. It shows you when to turn and when to stay on course. And a part of your strategy, you have to set your entry and exit criteria. You got to know when you're going to enter a trade and then when you're going to exit a trade. You have to specify conditions for when you're going to enter a trade. Is it going to be chart patterns? Is it going to be a trend break? Is it going to be supply and demand? But it must be based on price action. At the most foundational level, like I said, our jobs as traders is to guess the direction, when it's going to go in that direction, and when we need to get out before it reverses on us or goes against us. And only leading indicators can do that. So everything must be based on price action, which is price and volume. If it's not price or volume, it's not really going to do you much justice. And I know a lot of people are going to talk about SMAs and EMAs, like moving averages, but those pretty much just tell you areas of interest where you still need price action to confirm it. So why not just go with price action? And then you need to decide when to exit, whether for a profit or for a loss. This is your plan for when you need to stop and avoid fatality or take your earnings and leave for the day. Then you have to create a risk management plan. You need to limit your risk to a fixed percentage of your account per trade. So normally 1 to 5% is good to start out with. And the reason why I recommend fixed percentages because as your accounts grow, that percentage will grow along with your account. So your wins and losses will be relative. 5% of $100 is $5. So if you win a trade, you'll make $5. If you lose a trade, that's 5%, you'll lose $5. And same thing for $10,000. You make 5%, you make $500. If you lose 5%, you lose $500. So as your account grows or declines, the plan will still be the same no matter what. Think of this as your insurance policy, keeping you safe from total loss if anything goes wrong. Also, it makes it okay to be wrong. And I added also makes it okay to be wrong because a lot of us tie, including myself, tie our self-value or self-worth to a lost trade and a won trade. So managing your risk makes it okay for you to be wrong so you can relieve that pressure off yourself and also give yourself another opportunity for your edge to work and for you to make the money back. It just overall enforces good habits. All right, so we're almost done. Then you have to test the system. Backtest your system on historical data to ensure it performs consistently. Demo trade in real time without risking real money to validate it further. You can use the website TradingView to backtest. There's a feature on there called bar replay. In my upcoming videos, I'll be sure to show you guys how I backtest. Me personally, I've never demo traded because it doesn't allow you to feel the emotions. Feeling those emotions is very important. That's the determining factor between a successful trader and a struggling one. So backtesting is like testing a recipe. You tweak it and perfect it before you serve it to others. Then you have to build discipline and routine. So this is very, very important. We all know as traders we need to be disciplined. We know that we need to follow our edge. While knowing this, why can't we do it? It's because you need to improve your psychology and change the way you think. Instead of worrying about making money, you need to worry about losing it. Instead of trying to deny or ignore your impulsive trades, you need to open the door, acknowledge it, cultivate a relationship with that side. So everything that you're thinking now or your natural instinct, you pretty much need to do the inverse of. So create a trading routine, pre-market preparations, live trading, and journaling before, during, and after a trade. So for me, before the market opens up, I like to clean my room, clean off my desk, turn on some lo-fi, like a candle, because I just like peace and clean and all that shit, right? Like, I like to be in a meditative state of mind. And during my live trades, I have this thing where if my setup is not available, I step away from my desk. Like, I try to keep a distance between me and the screens and my mouse as much as possible. So I'll go wash my face, brush my teeth, go cook breakfast, whatever it is, and then I'll check periodically. And as my setup starts to form, then I'll sit down as my entry starts to present itself. And then once I enter, I set my stop loss, I set my profit target, and I walk away again. You're gonna hear me talk about set it and forget it trades a lot. And that's one of the big reasons why I named this community Minimal Trading, because the less you do, the better you perform. I would even argue to say journaling during a trade is way more important than journaling after a trade. Not only does it slow you down and stops you from making impulsive moves, but as you're journaling every single thought and every single thing that you see at a specific time in a specific condition as to why you're thinking this, like what triggered it, you can always go back and look in real time instead of after the trade when you can't even remember what just happened. I don't know if you ever play sports, but in-game memory loss is a real thing. It's the same thing here. So your routine is like a morning ritual that sets the tone for the day. And lastly, track and refine. Use a journal to document every trade, setup, entry, exit, emotions, and outcome. Find the patterns daily to identify what needs to be worked on and what needs to be optimized. This is your feedback loop, helping you to grow stronger after every trade. And in my later video, I'll do step-by-step on how to track and refine your trades, but I'll give you a brief overview of what it looks like right now. So after every trade that I take, I always playbook them, right? Well, I try my best to. Some days I miss, but I try to get majority of them. So let's look at, this was on the 29th. I took a bull flag, I went long, I made $2,300 that day. I didn't commit any errors. The setup was like a B grade, I would give it. My entry was an A, my exit was an A. I felt calm, and then my risk per trade, I risked 21 cents to the dollar, right? So I like to keep that simple. All right, and here's the trade. So we opened up on a gap fill. We didn't fill the gap, right? Fun fact, 70 to 85% of gaps fill. This is actually one of my strategies, but since we didn't fill this gap, I was looking at an entry for a gap runaway. So the gap didn't fill. We got a confirmed uptrend. Got a nice little pullback. I placed my stop loss at the bottom of the pullback, and then I entered long. I used the average true range as my profit target, which is $1 from the entry. And this is exactly where I took profits at. So you see how definitive I was with everything here? I labeled everything. I saw the setup. I'm getting more familiar with my setup to increase my odds of winning in the trades to come. So as we move down, you'll see that I have a lot of psychological segments where I talk about my execution mistakes and weaknesses. I had none. My execution strengths. I entered with proper risk. I didn't allow price to scare me when it came close to my stop loss, and I accepted the risk and loss. So my stop loss was right here. I entered right there, and price came crashing down. There was a very small gap between price and my stop loss. When it got to right here, I just let it be. And it just so happened to turn around. I didn't interrupt it. It was a set it and forget a trade. I didn't interrupt it. I didn't allow my fear or my emotions to make me do something to interrupt the trade. It turned back around and it ended up being a winner. I exited exactly at the profit target. I didn't think too deep. It's all probabilities. I managed my risk and I took the trade. Pretty much said fuck it. And if you want to go through the rest of the notes, you could just pause the video and go through them to see exactly what I was thinking and how I responded to all of my thoughts. So I hope this video helped you out. I hope you enjoyed the first segment of the course, and I'll see you on the next one.